everyone. Welcome to ESG Decoded. I'm Amanda Hsieh, and today I have Luke Oliver joining me today from KraneShares. Luke is the managing director and head of climate investments there and manages their growing climate and ESG investment suite. I'm so happy to have Luke on the podcast today to talk about his key article that was published in December called The Biggest Short, Carbon Markets and the Energy Transition. Hi, Luke. Welcome to the podcast.
Hi, Amanda. Good to be on.
Thank you so much for joining me. Will you tell our listeners a little bit about KraneShares just to start off with?
Yeah. Well, so KraneShares is a global asset manager, ETF issuer both in Europe and the US, and historically has been focused on China and the emerging markets. But as that market has evolved, we realize that perhaps the only bigger trend than the emergence of China as a leading global economy and driver of global growth is the fact that there is going to be the biggest capital cycle of all time related to the transition of the global economy away from fossil fuels. And so we've really capitalized on that. That's been my focus, kind of spearheading this new direction, this parallel pillar of the business, which is the climate investing suite. Majority of the business is focused on our China investments. And of course, without China, the globe isn't going to decarbonize. A lot of the technology, a lot of the pollution comes from the emerging, whether it be China, India, and so on. So we've really focused and done very well growing this climate suite. And I think investors will be really interested to hear how we approach it, because I think where ESG has come in for some criticism in recent months, you'll find that what we talk about today manages to stay directly. It kind of balances that line between having impact and being socially responsible and environmental, but really sticks to this being a pure investment.
Let's dig a little bit more into how you're seeing climate change and the risk and how it's impacting. I'd love to hear it from an investor point of view. You mentioned that's one of the biggest trends that you're watching. So tell us a little bit more about what you're seeing in that.
Yeah, well, so there's three real pillars of climate investing that we think all investors at the very least should know about, in our view, should be invested in and positioned for. And that is, you need to be long the carbon markets. And that's the carbon compliance markets primarily, which is essentially the regulation on growing carbon emissions. So you need to be long the carbon markets, you need to be long the correct equities. And that might not mean always the greenest companies, but it should be the companies that perhaps have large carbon footprints today and are transitioning to be some of the cleaner companies of the future. And then, of course, that's where the real performance comes from. It's that evolution from a old school, deep value stock to a growth and an energy leader of the future. And then lastly, we think the commodities are key. The commodities that will feed that transition. So lithium, cobalt, and so on. So we brought out a suite of ETFs that give you carbon markets. So KRBN's our flagship there. We also have a California only and a Europe only. We have KGHG, which are transition equities. And we have KMET, which is that basket of metals. And those are the three trends that we have very high conviction are where the market will need to perform and where all the impact and change is going to happen.
I think the second one, that would make sense to a lot of people, understanding that there is this transition that's happening, that there's value to be created, returns to be had from this transition. I'd say the first one, I think a lot of people are still learning about the carbon markets. I think there's people who are experts who are very deeply into the carbon markets, especially the regulated ones like California or some of the ones in Canada and around the world. But if you're new to investing in the carbon markets, what would you tell folks?
No, I think you're absolutely right. Like when you talk about equities, people, they're a bit more intuitive. They're like, okay, so these companies are going to innovate and grow and have an increase in valuation based on their new business model. Therefore, I want to invest in them. Very intuitive. Same with the commodities, I think. However, all of these things are kind of derivatives on what's happening. We know, and again, you don't have to like the fact that we're decarbonizing the economy, but please know that's happening. That is happening. All government policy is shifting that way. Not all politicians will say that we're shifting that way, but we are. Europe, Asia, US, all moving in that direction. So this is happening. So it creates these investment opportunities, and people start to look for traditional investments that should benefit from that. Of course, that's intuitive. The carbon markets, however, are almost a pure play on that. This is carbon markets, so compliance carbon. So the European Union's official carbon program, California's official carbon program, the northeast of the US, it's called RGGI, Regional Greenhouse Gas Initiative, is a government consortium of states in the northeast. But these are official government regulated programs. They are designed to reduce emissions by essentially issuing these allowances, these permits that over time will decline. So they're going to sell less of them in the future. And that reduction will create less emissions. But how? What's the transmission? Sure, there'll be less allowances, but it means the price of those allowances will rise as there's fewer of them. So companies can continue to pollute. No one's cancelling energy companies. No one's forcing anyone to do anything different. But just know that if you do not decarbonize, the cost of carbon, which has now been levied on the companies, is going to get higher. So the transmission for lower emissions is making them more expensive. And companies can choose to be less profitable and maybe go out of business one day in the future, or they can choose to decarbonize and be less exposed to the growing price of carbon. So you can imagine any rising cost to a business. Humans are great at engineering. We engineer away. That's expensive. Let's do less of that. Let's pay someone to invent something that means we can do less of that expensive thing and still serve our customers, still make money. So we're not carbon markets. Some people fear that it's like, some sort of draconian or socialist or overreach. It's not. It's just creating the environment for companies to decarbonize while still innovating and still arguably allowing the better companies to do even better. So this is massive opportunity. So all of that is to say, carbon markets are an asset class that has emerged in the last 10 years and has really hit the world stage in the last 2 years since we launched KRBN, that allows people to invest directly in the asset that is designed to go up in price to reduce emissions. And that is quite an incredible proposition. And then add to that it mainly correlates with tightening supply, not with the global economic scenario, not with geopolitics. There's definitely noise related to those things, but we have a very low correlating asset. So lower correlations and this potential asymmetric upside that these are designed to go up as we decarbonize. So it's a very pure play and it's really unique. And the last thing I'll say is that a lot of people say, great, that sounds incredible. I assume this is like a niche market. Like, how do you get it? Well, one, we offer it in an ETF. Anybody can go and get exposure to this through the New York Stock Exchange. But secondly, these markets traded about 900 billion last year. It's a huge market. It's not a niche market. So this is a really exciting prospect. And that's what we're here for, to educate people on this new market. And we're one of the only people out there having these conversations.
If we're speaking to retail investors, an individual who's investing, would you say this is on the riskier side, where they're looking at the overall portfolio?
Well, that's it. So it's absolutely more volatile than equities. We've seen roughly double the volatility of US equities, US large cap equities. So it is on the riskier side. However, the correlations are so low to US equities that actually blending US equities with carbon creates a lower risk portfolio. So what that means is that as a standalone, we do have to, be very clear to people. This is a volatile asset class. There are days where it's up 6% and there are days where it's down 6%. And intraday, it can move even more than that. So yes, risky, be very clear and eyes open to you're going to experience volatility. But if you're a somewhat sophisticated investor that looks at your overall portfolio, understand that this actually is a dampener on portfolio volatility. And in fact, we're in the middle of doing that research now to show you do an efficient frontier of a traditional portfolio and you add carbon, you move out and to the left of that efficient frontier. And that, as proponents of of modern portfolio theory will agree, is always a good thing. And so that's the longer answer. So yes, volatile, but very, very constructive to portfolio construction, reducing volatility.
I guess any thoughts about the voluntary markets, where the offsets are voluntarily created and traded, purchased and bought. And what are your thoughts there?
Yeah, well, so everything I've said so far is compliance markets,
Yes.
and that comes with transparency, regulation, standardization, everything that should give you comfort. And it's regulated, then it's traded on a futures exchange, which is regulated, and then our ETF is traded on the New York Stock Exchange, which is highly regulated, and we're regulated under the 1940 Act, et cetera, et cetera. So when you step into the offset market, now we do have an offset ticker, KSET for KSET, like offset. That fund gives you access to the futures on the offsets. Now, as you mentioned, people call it the voluntary market, and I don't like that term because while for the most part it's accurate that the buyers are voluntarily buying these offsets, to me, the real difference, or what characterizes them as different to the compliance markets, are that the compliance markets are allowances. They're not necessarily backed by, they're more like permits, whereas offsets or voluntary market are backed by projects. So you could have a forest, that forest as it's growing is capturing carbon, and that the person, by buying the offsets, you're funding someone taking the action to capture that carbon. So while a lot of it is voluntary, there is an element of the offset market that is in the compliance market. And as this market evolves, I think there'll be more of that. And I think there'll be a bigger push, both at a national and corporate level, to buy more offsets. And what buying offsets means is funding the removal of carbon, the capture of carbon, the holding on to carbon that's been captured in the past, as well as not just that's more nature-based, but also, industrial solutions. If somebody is creating a technology that pollutes less and replaces another dirtier technology, they can earn credits too. So the offset market, as I prefer to call it, is about creating negative carbon for the global economy that you can then monetize by selling it to companies that, while they are reducing their pollution, want to offset what they can't stop polluting today. So it's a very vibrant market, very new. I would say it is riskier. I look at that more as the frontier market, whereas the compliance market is more the developed, or even that's the emerging perhaps. Maybe there isn't such thing as a developed market at this point. So offsets riskier. We offer a product that gives access. Recent news, there was the John Oliver, the comedian, did a piece on this, but it was an insightful and kind of powerful piece. And the Guardian put out a piece that attacked some of these offsets. And so my kind of comments on that, because I get a lot of questions on it, is great. Challenge it, keep challenging it, keep holding the industry to a high standard, and it'll get better. We need that, but let's also be responsible. This is one of the most important things we can do to foster not just biodiversity and nature-based solutions, but create the innovation and the funding to really solve this problem. So yes, let's get rid of the garbage in the offset market, but don't kill
throw the baby out with the bathwater.
Exactly. Thank you. That's the analogy I was searching for. Let's make sure we keep this thing and make it better. And so I'd love to see, we're doing work in that space, and we want to see that market do very well, but it's very early. So I don't recommend that market to retail investors. I think you have to be very mindful. I mean, you can, and that's why it's available, and it is an interesting allocation, but eyes wide open, that's a lot more frontier than the compliance markets.
Mm-hmm. And at Climeco, we're in the thick of it because we are a carbon offset developer, and I'm very proud to work for a company that's very thoughtful and intentional and very careful, and it's been doing this for a long time, that they understand not only the business impacts, but also the societal, let's say, impacts of this. And it's very thoughtful about the projects we get involved with or not, and conducts a lot of due diligence, because I think those pieces brought a lot of scrutiny to the markets. And I think in some cases, it's needed for certain, just to raise the bar for everyone. I'm also I'm really proud actually to work for a company that takes this very responsibly and does the due diligence and the research and really thinks very intentionally. The other thing I wanted to ask you, I think you touched upon this before, is that we're seeing or hearing, at least in some of the newspapers and in states, certain states, this anti-ESG backlash. How do you describe ESG or what you're doing at Crane to people who either don't believe in ESG or say, oh no, it doesn't create value? What do you say to those folks?
Yeah. So interestingly, before there was a sort of this higher volume on the anti-ESG folks and ESG was emerging. That was our view from the start was anyone who wants an ESG investment is thinking in the right direction, but what they were served in terms of products was not actually intuitively what they really wanted. That's my belief. I think that measuring benchmarks and screening out some names and maybe overweighting some other names and saying this portfolio has great ESG scores, but it lacked what that portfolio really meant. And then people talked about, well, if you've got good ESG scores, you should be better positioned for the future and this should be risk reduced. But the evidence on that, what that portfolio did, was lacking, I think, a little bit. And so we designed these products very specifically to not, we didn't feel the need to even put ESG label on them. We feel that these are investments. And guess what? When you talk about investments and as an investment thesis and a risk return profile that is, is compelling to a portfolio, everybody wants to hear that story. And so one, commercially, that makes sense for us to tell it that way. But that's what we believe. We believe you should be investing, and we believe that the best investments will also have the most impact. But it might mean getting down in the dirty businesses to come out of that. I mean, our metals fund, it's clearly not a nice, clean process to dig metals out of the earth. I mean, look at cobalt, look at the amount of earth you need to move to get, a kilo of lithium. But we need to do those things, those dirty things, to do the clean things. And so we're kind of unashamed to say that's our approach. We're here to make money and to have huge impact. So we're neither the anti-ESG or the pro-ESG. We're investors. We're investors. Mm-hmm. We feel so strongly about that. And generally, everyone we meet gets on board. The ESG investors say, you know what? That's kind of what I meant. When I committed to finding ESG solutions, I kind of meant what you're talking about. And when we meet the non-ESG folks, they usually start saying, oh, you guys are climate guys. Is this a woke thing? And I say, let me explain. And I go through it. And usually at the end of the conversation, they see that subtle difference between having impact and seeking returns versus just saying ESG. So we're very pro solving the climate problem. Our investors don't necessarily need to be. Mm-hmm. And so, so it's a really interesting, kind of a privilege to be in this position, to be able to, and I really think that this is the right way to talk about it and the right way to approach it. And I think we're going to really solve the real problems like this. So yeah, we're right on that fine line between the two sides, and I think it's the right spot.
Well, that's a fascinating thing, right, about market-based solutions is that as your business grows or your value grows, your impact also grows. I think that's a fascinating thing about thinking about these market-based solutions and how can we incentivize, and the pricing will naturally adjust based on supply and demand for the product. And if we've designed a good product in high demand, it should naturally appreciate, right?
But flip that around. If something relies on investors being nice or doing it because it feels right, that probably won't work. Not because we're not good people and we don't want good things to happen, just economically, it won't get enough buy-in if there isn't money to be made. Every single market that exists is a combination of sort of regulation, which is, I guess, the more socialist side, and capitalism. It only works when you have the right marriage of the two things. So if it's only about doing good, it just won't get the real capital flows. So it has to be about capital. So the solutions will be found, but it will be the solutions that can make people money that will be the ones that really work. And that's okay if we solve the problem. And back to your thing on the article, that's great. If on this path of capital seeking solutions, some of those solutions are not good, we need journalists to say, hold on, is this as good as you think it is? And then that should, and it has, led to some defunding, I think, of some of the bad projects, or it's causing corporates to sit back and not buy all the offsets on the market today because they're now not sure which ones are the good ones. And while that slows things down a little bit, it might mean we move forward with the better quality stuff in the future. So you've got to kind of trust the system a little bit, and it's challenging. But if it really is going to work financially, then you're going to get real flows, and that's where you're going to get the scaling and the innovations that are going to make the change. It's a really good marriage of the social side with the capitalist side.
I agree. Luke, thank you so much for being on the podcast today. We will definitely link up Luke's article, The Biggest Short, Carbon Markets and the Energy Transition. Luke also has a blog called Climate Market Now. I'll make sure that's also in the show notes for anyone who wants to read more about Luke's thoughts and what the trends and drivers that he's seeing globally. It's another resource that we'll make sure to link up. But Luke, thank you so much. This has been wonderful.
Thank you so much for having me. And yes, please share those. And anyone, feel free to reach out with questions. We love talking about this.
Awesome. Thanks.
Thanks, Amanda.